Can I welcome everyone to the Trade to Win Summer Forex Bootcamp. I'm glad to be here, I'm sure you are. Are you glad to be here then?
Yes, so far.
Are you expectant?
Yeah.
I am. By the time you leave here today, I know and I trust that you would be Forex traders for starters. And in 2 weeks' time, you'll be good to go, you'll be making money. Seriously speaking, that's what's going to happen. No jokes. Well, this is going to be delivered by me, of course, Tommy Thompson. I'm the head trainer of Forex Training Online. And basically, that's who I am. I've been training. Yeah, you are welcome to the Trade to Win Bootcamp, August 23, 2014. Delivered by me, Tommy Thompson, head trainer and founder of Forex Trainer Online. This is module 1. Before I start that, I just want to keep an overview of the of what we're going to be doing today. I'm going to be teaching how to make money from the forex market, not quitting your day job. Or if you're a student, how you can make money from the forex market and also staying, as a student, not stopping without jeopardizing your success, at the uni. So basically, how I'm going to be doing that, I'll be doing it in about four modules. And one of it will be the foundations of trading. There are going to be stuff there, developing a winning mindset, the basics of trading, and then I'll be defining some forex terminologies and all that. There will also be the second module, which is finding the right approach for you to trade. I'll be looking at your personalities. We'll be talking about personalities and how to determine if you're going to be a fundamental trader or a technical trader, or you're going to be both, like me. The third module will be how to guard against losses. How to guard against losses and how to cash in on your positions. That means how to take profit. You will be surprised that you will be in a trade that is positive, and some people don't just know how to pull the trigger and take the profit. It's part of the emotions of trading. Sometimes it's about greed. You think it's going to go a lot longer, or sometimes it may just be fair. What should I do? What should I do? Anyway, and then also we're going to be doing the hand-holding session. There will be the Q&A sessions too, and all that. So basically, that's in a nutshell. That's what we're going to be doing. So we're about to start the first module, which is Forex Trading Foundation. Of course, delivered by me. We've looked through the disclaimer. What was that? We've looked through the disclaimer. So the first bit of the foundations of trading is developing a winning mindset. Wow, where should I be looking at? You've got to believe in the industry. I said this at the webinar 2 weeks ago. You've got to believe in the industry. Some people tend to say that the stock market and the forex market, that they're rigged. Yes, there are some bad elements there. They do insider trading. Basically, what they do in that is that, let's say Toby is an entrepreneur, a big massive one. He manufactures this water. I don't want to advertise for that. I haven't been paid. Let's say they manufacture this water, for instance. Toby knows or feels that he's going to do something that is likely going to make the shares go up. So he will tell it to maybe Gbenga, and then Gbenga will go and take a position. That means he will go and buy the stocks while it's just still hanging on there. He will buy it big time, and then Toby will make the announcement. So Gbenga will make that money, and then they will share. That's what people do when they do insider trading, and they get caught for that. They're sent to jail, 15 years, 7 years, 8 years, all sorts. So that's what they do when they do that. So because of those sort of little people who do that, people tend to feel that you can't win them anyway. You can't win. No matter how much you try, you can't win. I'm winning, I can tell you, and you really can win. You can win, and consistently, actually. When one of those things happen, there's a way to protect yourself from the losses. I mentioned it earlier on about guarding against the losses. I'll be teaching how to do that too. And believe me, just like I'm saying, you have to believe in the industry. You have to believe what I'm saying to experience it. Yes, some people do it, but it's not all the time because they get caught and they get sent to jail. So once they do it, you'll be able to protect yourself. I'll teach you what to do to protect yourself from the losses if that happens. Feed yourself with positive materials. What we're saying is that you should be reading stuff like this: positive blogs, Forex Trainer Online. That's my blog. www.forextraineronline. That's my blog. You should be reading stuff from people like me, other people, to other information. Listen to Bloomberg and all that. Get the gist. Know what's going on in the industry, because a lot of the times when you know what's going on in the industry mentally, at the back of your mind, you are knowing that we're in a positive atmosphere at the moment. So trades that you're going to be taking will be positive at those times. I'll tell you how you marry what's going on in the atmosphere with what's going on your screen. Because sometimes you're looking at something on the screen and it just doesn't. Cameron is shouting, oh, the economy has grown by this percent, oh, and unemployment has gone down, and you're seeing the stock market going down. I'll tell you what to do when there's no sink, and when there's sink, I'll tell you what to do, stuff like that. Surround yourself with positive people. I can tell that if you surround yourself with people that are in this room, I can see there are people who want to learn, they want to know. You don't want you don't want people who are going nowhere. Me, I play a lot, but I'm a dead serious guy, but I play a lot. I don't take life too seriously, because I know what to do when I'm in need. Surround yourself with positive people who are going somewhere, people who are doing things, people who are setting things up. Anyway, that's basically surround yourself with positive people, and be wary of negative people, because that's the other side of it. Stop going on negative blog sites. They will only dampen your spirit. I told you about me trading for quite a while, and about 6 years of it had been up and down, make some money, lose some money, make some money, lose some money, because before I became consistent, and then was bold enough to begin to teach people what I do to make me consistent. Be wary of negative blog sites. I don't, when you see stuff like that, yes, you want to listen, like, what have they got to say this time around? Do you know those TV stations, those internet TV stations that just talk negatives? A lot of them are in America. Have you heard them before? They just be talking negatives about Obama doing this. They will just be looking for something negative. When I first started, because I wanted to know everything. I wanted to know everything. I would save it, listen to the negative and I listen. But then after I just thought, do I really need to be looking at this thing? I already know that this thing works. The first day I traded, I made 3 positive trades in a row. So I'm thinking, even if I lose afterwards, that means I haven't learned something properly, or I'm still doing some things, and that's how I learned that. There are things to do and things not to do. I put that phone call. Be wary of that phone call. There's this person that tends to call you, and it's quite negative. And when you're talking about forex, this is your forex thing. Let's go and do. I don't want to run down any industry. Let's just go and do something else or something. This thing will work. Be wary of the short people. They're just going to dampen your spirit. Invest in training. Of course, you've got to learn. Invest time in training. Invest in books. Yeah, no knowledge gained is lost. Invest your time. When it's time to go to log on, if you're free, you can put the thing on and just put in your ears, and you would hear people talking. You can come there, have a look later on, rather than just gisting. Those are the things that build you up. You won't even know as you're getting built up. After a while, you just find out that, oh, I know this, I know that. That's going to be what your experience will be. The basis of forex trading. The basics. It's how did trading start? Well, for trading generally is buying and selling. We know that. And when you do it online, you buy and sell. For financial trading, you're buying and selling financial securities, all sorts of things, gold, oil, anything. They say there are over 7,000 instruments that you can trade from on the markets. But I've found my own niche. I've zeroed in on forex, and even on the forex, there are just loads of pairs, that you can trade. I'll tell you what pairs means. It's not a big deal. We'll talk about that. But I just focus on pound to the dollar, basically because I live in London, and we all know that dollar is the store of value. When something happens in dollar, and with the dollar, the market rocks. If something, oh yeah, it will move. I'm what you can call it a momentum trader. I know when to go into the market. I know when something is about to happen. That's basically my strength. I know when it's about to happen. I know when to go there. I play on Facebook like no man's business, but I know exactly when to go. I set my alert on my phone. 9:30, this is gonna happen. I come there 9:25. Hey guys, I'll chat to you later. Someone described me as cherry picking. I can't mention his name. He didn't, I can't. So don't take it too seriously. If you're a student, set your mobile phone alert. Once you know what you're supposed to look for and when you're supposed to look for it, you will see it's not that difficult at all. So really, how it started. They used to have there used to be the days of the days of trade by barter. Yeah, you've got this, I've got that, I need that, I'll give you 2 of this and you give me 1. And then after a while it started to, oh okay, let me show you. You've got many cups or many bottles of water, and the one with the cups needed that. The one who needed the cups, basically just an exchange. You just exchange one for the other. That's how they started with trade by barter. Sorry, trade by barter. And then after a while, they started to have the cowries or whatever it was that they had. Just have something that's valuable to exchange. Started to exchange with gold and all sorts. Anyway, long and short, they got to the point where each country started to say we've got to have something by ourselves to use as a store of our own value, and then basically started to exchange. And each currency started to find their strength. Basically based on what the economy of the nation is performing. That's what usually affects the strength of the currency. So basically that's how it started really. It went from trade by barter and all that to all sorts of stuff, but we found ourselves in the position where each country has their own currency, and you're trying to buy something in that currency in that nation. You've got to exchange your own money, because that person will not take your own currency. So you've got to exchange it at the market, which we call the forex market, foreign exchange market. You exchange it, and then you're able to use that currency to buy something. So while you're doing those businesses behind the scene, the markets are moving, the values are being calculated. There's a central body, the New York Stock Exchange, the London Stock Exchange. Let's just say this might just be the stock exchange. You might represent various countries. So if your country has 10, 50 billion, worth of gross domestic products, whatever, and then he has maybe 30, that's 3/5. The strengths it's very complex, and you don't need to go into it. And that will just launch me straight into that, into one of the myths. Some people think you've got to have a degree in investment and fund management, some masters and some doctorate and whatever. You don't need it. I can tell you don't need it. The reason why you don't need it is because those who have it, they've gone to study, they've gone to learn it. You tend to hear them all over. There are places you need to go to. You could go to Bloomberg, you would hear all the experts. You could go to their websites to go to. I'm going to be giving you all of those. Forex Trader, that's my blog. Forex Factory. You can go to Forex Factory, you just see all the information, and they're all for free. So I'm going to be sharing all these things. No, you don't need to write it yet. I'm going to send my presentations to you. You're going to have everything by tomorrow. You'll have them. Because really, I would have printed them and handed over to everyone, but what I've noticed is that each time you do that, people tend to look through it and they want to write it, But I can see the way people are looking at me right now. It's better that way. It's engaging, and you're able to impart. The more you try to take from me, the more that I'll give to you. You're going to notice before the end of today that you'll be the tired one. Despite the fact I didn't sleep well yesterday night. Anyway, so basically that's how Forex started. So now this time around we're going to be talking about the Forex basics. We're going to be we'll be defining. I'm going to be explaining the Forex language to you, so that it doesn't feel so way off and daunting. What is Forex? Forex is foreign exchange. I've tried to explain So what is Forex? Forex is foreign exchange. I've explained it a bit. That's exchanging currencies between two nations basically. It's a very complex web. Many countries exchanging this and that, and they're calculating the values and all that. Well, what is the forex market? The market is where you trade currencies. That's where you buy and sell currencies. As simple as that. The stock market is where you buy and sell stocks and shares. You manufacture that book. He manufactures the iPad. And then, you're calculating how much worth of this is bought, how much worth of that is bought. It reminds me of the central bank. I used to work in a bank back in the days in Nigeria, and when we go for the clearing exercise, you would have issued your checks to your customers, so your customers would have given them to Toby's customers at the back. So all of you will come to the desk. When you present yours to the bank, they will send it to that bank. It's quite complicated, but I can understand it. And then you now start to exchange. I'll start to call Union Bank, 5 checks from our customers. Let's say I am New Nigerian Bank. Union Bank, 5 checks. First Bank, 15 checks. And then they will be doing the exchanges among themselves. And then the clearinghouse will be the one to mediate till they have it. Anyway, it's quite complex, but that's just the way it is. That's what usually happens basically in the markets, in the international sense. That was just between local banks in a country. So all the countries are like that, basically. It's all done computerized now, probably. They all sit down and then they exchange the values and all that, and then they come up with a figure. Currencies are traded in pairs. What that means is that a currency you can't buy a currency with a currency. You can't say I want to buy £50 and then you go to the central bank and then you want to buy £50 with £50. You've got to use another currency to buy another one. That's the reason why you see stuff like the reason you see stuff like this, pound to the dollar. That's how they quote it usually, and they say, that's how currencies are traded. Basically, pound to the dollar to the francs, naira to the. It's not in the worldwide market. Anyway, sorry.
Naira to what?
Naira to cities. Wow. So, what is a peep? Now we're beginning to get into the forex jargons. What is a peep? A peep is just a unit movement. Boom. The currency is calculated to 4 decimal places. Usually in the world, when people operate, we operate with 2 decimal places, isn't it? £1.50, 1 naira 55 kobo. But in the world market, it's done in 4 decimal places. 1 to 1.600. It's probably anyway. Let's just say 6000. What this means is that £1 is $1.60. But in the forex world, you do it to 4 decimal places. Okay. So you can have 1.6243. Do you get it?
Yeah.
Does everyone understand that?
Yeah.
Understood. So it's done to 4 decimal places. So 1 pip is just this one. So let's say the dollar falls against the dollar by just 1 pip. The price would have risen to 1 point what?
6244.
Sorry?
6244.
Yeah, 6244. And that's just a rise of 0.0001 pip. So that's 1 pip really. 1 over 10,000 pence. So really, so when they say, so when you hear people talking and they're saying that, oh, the pound rose by one cent today, what they're saying is that just rose by that little one. If it should rise by maybe 100, it's a major thing for the currency on that day, or 4. Yeah, because people trade in billions, and so that little 1 pip, maybe 10 million to some people. So someone asked me a question: someone asked me at the webinar, how much have I made the highest? And I never answer that. And the reason I don't answer that is that I don't want people to have an impression in their mind and limit themselves or underestimate themselves. What this means is that if we started trading today, I'm going to be concentrating a lot on we won't forget it. We need a guide. I really want to get into it, but I'm like that all the time. So, let's say the market just rose. Something happened at 9:30. Let's just say A president died, I won't name anyone. And then suddenly the market just rose 1 second by 100. This just turns to 1.6100. The market rose by 100 what?
Pips.
Pips. In currency, they call it pips. In stocks, they just say points. You know, it's really nothing. So when we're talking on Facebook, can you be who saw that 50 pip rise? And then someone, what are you talking about? You guys just get off this place, you know, away, you know. And those who understand that it's not a big deal. Pips, just 100 movement. But that can happen in 1 second. So for those people who are multi-billionaires, who've got billions in their accounts, when that rises by 100, they probably have made, maybe let's just say 100 million. They could make it so easily like that in 1 second. And then if you've got 1,000 in your own account and you're trading with maybe let's just say 500 points, that might be 500 for you. So for them it will be 5 billion, for you it will be 500, but you will see that it's the same tactics that you need, the same strategy that you use. Well, they tend to make, the big people tend to make their own a little bit complicated, and because they're dealing with loads of money, so it makes them feel we've got to analyze it to the last, you know, to the very tiniest of details. But really, well, probably if one was trading with massive, you know, banks, money and billions like that, you might want to be very careful. Really, you should be careful with your money too, because it's all hard earned. You know, people go to work 9 to 5. Some people do overtime and all that. You know, but that's about pips. So that's 1 pip, 100 pip in 1 second, basically. So, what is a candle? You've got a chart like that. You've got the time along these lines. For those who did their maths in school, I remember that's the time, and this is the price. So we've got price rising like that, and we've got time like that. A chart can be in, let's just say in hours. Let's just say hours. Or it could be in 5 minutes.
Mm-hmm.
Are you listening? It could be in 5 minutes. It could be in hours. So this could be you wake up in the morning 5 a.m., 6 a.m., 7, 8, 9, 10 a.m. This is the price, and we're going to be using the pound to the dollar as an example. So our price goes from 1.6. Remember 4 decimal places. 60000. No, 1, 2, 3, 4. And then 610, 1.6, 0, 10, 1.6, 0, 20. Oh no. So for those who know about graph, you would, after a while you would find a graph like that. You know, it could go like that. So these graphs, you just connect the points together and then it comes as a block. This is what we call one candle. And this is that simple. Histogram. If you know about histogram, or you know about line graph, sometimes you can present it all sorts of ways. It could be presented like a line chart like that. Sometimes you just see it like that. Mm-hmm. Basically that's what they've done. They've just connected all the points together and just gone like that, and maybe it fell again at 8 o'clock, it went down, you know, and then it went up again, and then it went passively down at 9:30. You notice I've been talking about 9:30 a lot. I'll tell you the secret later. When you know about why things happen, you'll be able to take advantage of it. You know, the guy that taught me, when he taught me, I started to ask him, well, why is it that thing happens early in the morning and sometimes it won't happen? Because, you know, you taught me to do, and I thought it was going to happen, but this day it just went down. I'll tell you why the market shouldn't surprise you, except stuff like maybe a president dies or something really drastic happens. Nothing should be surprising you in the market. Okay, when rogue traders cheat and they do stuff like I just described about insider trading and all that, when they do stuff like that, of course, there's nothing you can do about it. You did your own right, but I'll tell you what to do to protect yourself against it. But really, the market shouldn't be surprising you. You know, and I'll hear stuff like, wow, that thing just turned suddenly. Nothing surprises me. I'm waiting for it. I'm not even in the trade while it's going up, but I'm waiting for that big drop of 9:30. So while all this is happening, I'm playing, I'm chatting, I'm laughing. And you know, when you do that, it takes away your forex trading is quite addictive, you know, because it's everyone wants money, and if you look in the market, something will be happening or something won't be happening, and every time something is happening or not happening, you can still trade and make money. When the market goes down, you can make money. Actually, when it goes down, is when traders make more money, and I'll explain the reason, and then you would know why. Some people don't want to make money from other people's miseries, but I don't know. You know, if you don't like it, you might decide to just be a bull. Just make money when the market is going up. If you see a down opportunity, if you have issues with the morals of making money when people are losing, if you have issues with that, all you need to do is do not go selling. We call it short selling. I'll explain that to you when we get there. Don't sell at all. Just make sure when the market is up is when you go to it. And there's a way you can look at all sorts of securities: pound to the dollar, euro to the dollar. One may be going down, one will be going up. You would always find the time when one will go up or down. You know. So what was I talking about? Yeah, I was talking about the candle. So that's a candle. We've got two types of candles. Like I told you, the candles represent the movements, the price movements of the security. So I won't be talking like we were talking at the webinar anymore. You know, DJ just kept forcing me use oranges, and you would say I wasn't really comfortable. I have to be trying to remember the oranges and the mangoes analogy that we were doing and all that. You know, so we call them securities. Securities are just an instrument. You know, and an instrument also is whatever can be traded on the markets. So it represents the movement of the price. This is a rise, that's a rise, that's a rise, that's a rise, that was a rise, and this was a fall, another fall. That just means in 1 hour the price rose from this to this, it rose from here to here, it rose from here to here. Do you understand it?
Yeah.
Toby, do you get it? You're sitting far away, that's why I asked you. And I know you quite well, you're very sharp. I'm sitting here praying. Anyway, so two types of candles. The green one just tells you that the price rose in that period. It shows that it rose from here to there. It rose from the open price to the closed price. I'll just parallel it. The red one did what? Dropped from this open point to this closed point. Her name has gone off my head. Good. So, sorry, what's her name? Quite embarrassing. Deborah. Did you understand that?
Yeah.
Okay. So basically, we're trying to okay, the paper is well. What we're trying to say is that this price movement is what you see as that green one that you're looking at on the screen. So when let's just say, okay, I've got to put figures there. Let's say that's a movement. You see it's got a tail at the top and at the bottom. Let's say this was 1.6000. It dropped to 1.5980. That's a drop of 20 pips. And this was 1.6200. And it rose to 1.6220. And this is the green candle, an up one, a green candle. Does everyone know what this means?
Yeah.
Okay, actually, let me just explain it. Okay, it rose. So the at this hour at 6 o'clock, let's just use 6 o'clock. Then you look at the screen. The price opened at 1.6000. The reason for this tail was that in that 1 hour, it first of all dropped a little bit to 5.980. Do you get it? You get it? If you don't get it, just say yes. I'll explain this one over and over and over and over. I could explain this for 20 minutes. But if you don't get this, you won't understand the rest. So if you don't get it, just say that you're not understanding it if you do not understand it. Like I told you at the beginning, there's no stupid question in trading. So at 6 o'clock early in the morning, the price of the pound to the dollar was 1.60000. It first of all dropped to 1.5980, as if it was going down 20 pips. That's 20 pips down. And then it rose all the way to 1.6200. That means from here it rose all the way there, and then it went further up to 220, and by the time it was getting close to 7 o'clock, it started to drop a little bit, and then it ended on 1.6200. Does that look complicated? Ask anything. Ask.
What's the time
Yeah.
measurement for a candlestick? Is that an hour?
It varies. You could set it. If I'd logged onto my account now, I have actually. You could set it to be every 5 minutes. Remember we spoke about at the webinar we spoke about knowing your personality and how you'll be trading. I like to trade with 5 minute candles. Actually, I'm a multi-time trader. I would open like 4 screens, like 4. Divide my screen into 4. That's what I mean. One will be on 5 minute charts. One will be on 1 hour chart. One on daily chart. One on weekly chart. So what that means, what you're looking at, if you do it on a 5 minute chart, you would usually have 200 of 5 minutes, and you'll be showing maybe about 40 candles or more than that on your screen per time. That means 45 minutes. In the past 200 minutes, this is what has been happening. So if you set it to 1 hour, it's going to show you 200 of that. So the past 200 hours, this is what the market may be rising generally, but while it's rising, in the small time, it might be doing this and doing that and doing that and going down and going up. So if you look at a chart, if you look at a 1 hour chart, you might just see the market going up, and you can probably draw it this way in 1 hour. You can do it that way probably. But let's just say this big that dipped maybe 20 minutes. So if you did it in 5 minutes, you could be seeing this going down. Do you understand? So looking at it in 1 hour, you see this. Looking at it in 5 minutes, and on the same screen, and it looks like it's going down. That took me years to figure out. Years. I did not know. No one taught me. I did not know. Thought that little dip in a one. Let's say it's a 1 week. You see the picture now. It's a 1 week. So this would represent a day, and in 1 day, the market would have gone up, down 200 times. So really, you need to know what you're doing. You need to know so that you won't get confused. Because if let's say we're talking and we're in the group, and you set your charts, you went aware. I'm going to give you a setup guide. So don't worry, it's not daunting. Step by step, how you set up in the morning, how you split your screen, how you do everything. I'm going to give it to you. And let's say we're just talking. Wow, the market is bad today. I'm thinking in my mind, they're going up today now. But let's just say you just came while you had a short break, and what you met was this that was happening. And on your screen, it looked as if it was going down. And you're thinking, we're going to. Something are you selling today? Say, okay, you've got to be buying. Look for the, I don't know. I'll tell you how to know when to look before you start to buy. So even if the market is going up, you don't just jump in. The market is going up and down and up and down. You don't jump in when it's at the top. It's when it's gone down, when everybody's thinking it's going down. This is one of the, actually I've got to say to this camera, this is one of the reasons that most people lose money in the markets. They look at the short-term view, and they are thinking it's going down, but really on the bigger picture, it's going up. No, I was going to add another just came to my mind. And look at it this way: if you open that door, and people are pushing from the hinge, you need just one finger or just 2 fingers. You don't need a lot of energy to push from the edge of the door. But if you are pushing it from the hinge, it won't move at all. Yeah, it's similar to that. If you are with the bigger picture, you're likely to win more than if you go and stay with the smaller picture. But then I trade with the small picture. I still don't trade with the big one, because if you're trading with the big picture, you've got to be trading. You've got to have you've got to have a bigger picture in your mind. I can see it on the chart quite alright. I know what they're doing ultimately, but in the short term, I told you that trading is 70% psychology. Strategy is just really not much. Always when I'm talking is just I just want you to understand it very well. That's why I'm saying all of this. Trading is usually psychology, and psychology happens within fraction of a second. That's the reason I go to the small candles, the small time frame. We call it time frame. We're going to get there too. Anyway, you're going to ask a question.
Yeah, I'm just clearing it, what you explained up. The candle is where the market started and where it ended.
Okay.
Is the wick where it have high and low, it fluctuated?
It's the what? Say that again.
It's the wick. This
Yeah, yeah.
how high and low it fluctuated.
The
Yes.
full range.
Yes.
Yeah.
Yeah, you can call it a range fluctuation, yeah.
Okay.
Okay. At the beginning I said there are two types of candles. The green one is the one that goes higher. From the open price, we just say open. This is in this hour, this is the price at which this candle opened, started or began or whatever. But we call it open. So the highest it went in this hour, Deborah, the highest it went in this hour was what? What price with this example?
Oh, okay. 1.6000.
No, the highest it went.
1.6.
No. Let her do it.
1.6220.
Yeah, that was this.
Yeah.
The lowest went was the lowest.
I can't see.
Okay, 5980.
Is it 80?
Yeah,
Okay.
that's the lowest it went. That's the highest it went. But when the price opened at 6 o'clock, remember I said this is 6 a.m. to 7 a.m. This is an hour candle. If it's a 5-minute candle, within 5 minutes it will do zoop, 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 zoop. If you expanded this, you'll be seeing stuff like this.
Yeah.
That's how it's going to happen. So we're just representing it in one candle. This is the highest. This is the lowest. This is when it started. You know, do you see the picture? And this is where it ended. So that move is where it's. We've exhausted it already. Oh, sugar. Okay. We went like that, like that, like that, like that, like that. So this is what we interpret as. No, let me put it beside it. As this. This is the open price. Open, this is where it started. O. This is the close. This is where it closed. This is the highest, we call it H. And this is the lowest, we call it an L. So open price will be here, like that. This will be interpreted as this on a candle. You know, this is the line graph. Line graph. So on a candle, it will be open will be here. Yeah, but what will be here? What point will this be on a candle?
That should be open as well.
No, this will be the close. Oh, yeah. This will be the close point. This is the opening price. This is this open here. Oh, yeah, close here. Then the highest point H here.
Yeah.
What will be this one?
The
The
lowest.
bottom of the way, that's
The lowest peak.
15980.
1.5.
No, that's not what I mean. I mean, what would I label it? Bola. What would I label this? Yeah, low. Should be high, obviously. So that's this point is this one, the highest point. So the candle will be highest like that to lowest. So this is L, this is high. So this close point will be here. So this will be C, and this open point will be somewhere here. So you would have the candle like that. So really, when you're looking at it, it's not. You know, when you're looking at candles and they're in operation, they'll be changing colors sometimes because it goes up. If it goes higher than the open at any point in time, the color will be green. If it goes higher than this, and if it comes lower than the open price, it will be red. It's almost like it fell. So, and that's the reason that if you're looking at a candle, when you come in and you see a red candle, and then maybe 10 minutes later, I come in and that's an hour chart. A fully green candle may have turned to red very, very long in 20 minutes time. So if you go look at it and you're not looking at it at the same time, real time, you'll be saying different things to each other and you will give him an advice and he will be, you won't do what you advise him to do, because if you say, what can you see? Oh, I'm not logged in, what can you see? I see 3 red candles on the hour. Oh, that's massive then. If in 3 hours it's been dropping, most likely it's something serious. What's the time? Have you looked at the timing? What are the data coming out? And we will get there. You're going to know all of it too, before the end of the day, today.
I guess it's not.
You get it now? Okay. So, basically, that's how a candle operates. So the red one is the one that closes lower than it opens. The green one is one that closes higher than the price it opened. Is that clear, Bola?
Yes.
Is it clear?
Absolutely.
Very clear. Okay. Now this is the challenge. Oh sugar. Yeah. I'll skip it. Yeah, a chart. Okay, bars. These are bars. Candles form a bars. Bar chart. Is it cool? Deborah. What's Deborah's name into my?
So you call me Deborah
It's
or Oyinda?
Oyinda. I think.
I'm used to calling her Oyinda, but she's not using Deborah. It's just conflicting. Deborah, I'll call it R.A. Deborah. So, we're speaking about candles. Candles, they are really bars. You can see that they're bars now, bar chart. This is the line chart, but really they're really talking about the same thing. And I also put line, okay, line chart, bar chart, and all that really. So, what is a chart? A chart would go like that. I'm going to be using them interchangeably. When I want to talk about details of it, I'll use the candle. Here there might be 200 candles here, but we didn't draw it like that, like that, like that. We didn't paint them colors and all that. But really, this is what is happening here. As it's going up, it's increasing, and then it dropped. The long red one came down at 9:30. I keep saying 9:30. Another one at 1:30. All sorts of things happening. Anyway, so what's a chart? A chart is just a group of candles coming together. Zoo, 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 zoo. So I said, bring up the euro chart. And then I also tell the euro chart means the euro to the dollar. I don't feel like euro. Yeah, E, isn't it? euro to the dollar. And then you just see that. So all the candles have come together to form a chart. If you want to call it in the layman's language, what we call it graph in school. Graph. So you hear some people saying, "Oh, I looked at the graph for whatever," but you just want to say you looked at the chart. That's what it really means. A time frame. The next thing to talk about is the time frame. I spoke about. I said you could set your chart to reflect every a new candle every 5 minutes. So it's going to be showing a new candle in 5 minutes. So you can set it to be in an hour time frame. If I tell you that, or if I said, what's happening in the market today? The market is going down. Can you understand why you can't just say it's going down like that? Basically, maybe if it's lower than the open price, it's going down. But a lot of things may have happened. There will be lots of money at exchange hands buying. And when I came to the market, I saw it down. And it looks like, this thing looks negative. But you've got to look at the history to be able to really, really tell what is happening. What I do usually, I'm going into setting up, I'll just mention it briefly. What I do in the morning is, I'm listening to Bloomberg. After a while, you won't even do that anymore. You tend to know, as you go on. But usually, I put on the Bloomberg, it's going on at the back. And that's where the experts are analyzing. The presenter or the producer has gone to bring in all these experts. He will bring in an expert for a buy case, an expert, don't worry, you'll be confused, for a sell case. And this one will come, Toby will come. Who even knows? Maybe Toby has gone to invest in something and he will come and talk it up. They do that a lot. They'll just come and then you'll be thinking, the same market, they're looking at the same market, and somebody is saying the market is going up. You will see maybe the Europeans, I'm not trying to say that Europeans are wrong, no, they're not wrong or something, but I'm just trying to compare two zones. The Europeans may be saying, the economy is bullish. By the way, bull means up, it's going up. When you say, it's bullish today, the bulls are in control today, that's what they're saying. The buyers are more than the sellers, so the market is going up. And when they say the bears are the ones, you can see that the nature of the bear, can you see it running and it's going like that? They're just trying to say the market is going down. I was going to say something just now. I lost my train of thought.
Let me just stop it and change it now. There's only 5 minutes left on this tape, so I don't want to...
Let me finish this time frame, and then we'll do resistance and support. Resistance is major. I don't want to mix it with the time frame. 5 minutes. Okay, so the time frame, basically all it means is that what are the candles measured? How many times the candles are popping up? So a candle pops up every 5 minutes. Your chart is in a 5 minute time frame. If it pops up every 1 hour, and then you can set it by yourself. I told you about opening a multi-screen. Split your screen cell into 4. Let what be in the daily chart. It tells you what's been happening in 200 days. That will be in the 4-hour chart. The banks, they tend to stay on the 4-hour charts. You need to know that too, but You know, the big, massive investors, they stay on the weekly, monthly, annual charts. People are looking at charts that's doing one candle is doing maybe 2,000 pips. You know, so you would understand that you've got to put a lot of money in the market for you to be operating from a 1 year chart. You're talking about Warren Buffett just putting 15 trillion or something there and just waiting for 1 year. And you know we are somewhere there in the middle while it's doing all this up and down. We're trying to take advantage of, you know, the mini movements. It's going to be mini compared to it, but then it will be massive. If you make 50 pips in one trade in 1 day, if you make 50 pips in 1 day, Father Lord God. Well, like I said, it also depends on what you put into the market. You know, if you're trading with £10,000 and you're trading, let's just say you're trading £20 a point, and you make £20, you make 400 in that one trade. And forex, you can see 100 very easily. So that's about where we're doing the forex basics. We've spoken about forex. We've spoken about the markets. We've spoken about pairs. We know what pairs is now. We know what pips are now. Candles, bars, lines. What a chart is. A chart is just a combination of all sorts of candles. They come together to form a picture of the price movement and all that. So we're going to be talking about resistance and support.
You don't need anything here.
Hi, my
Yeah,
name
just
is
check it.
Deborah,
Alright,
and I'm here today because I came to the
Take it.
Trade Forex to Win bootcamp, and
Everyone
I
has
enjoyed myself.
absolutely
It was
gone
very
very well.
interesting, and I learned a lot.
Remember, this may be on my
I feel
website,
like
on my blog.
a part of
So
an
then
industry that I thought I'd never
okay.
ever get to look at or see or understand that I'm exposed to, and it really has met my
Look at her own.
expectations today.